The cryptocurrency industry currently stands at $3 trillion. If we project its growth trajectory, its adoption rate is developing at twice the speed of the internet. However, as adoption rates for the internet slowed due to market saturation, we can anticipate a similar slowdown for crypto. Even so, by 2050, we could reach approximately 4 billion users. This suggests that the asset class could grow to $100 billion, and we're only about 3% of the way there. This represents the largest and fastest accumulation of wealth in human history, offering opportunities for anyone, anywhere, regardless of income. It's a transformative economic shift, and what I consider the greatest macro trade of all time, fueled by network adoption. As more people join these networks and as applications are built, the networks grow in value. Beyond this, the ecosystem is divided into companies or projects offering block space, essentially providing data storage. Each project has its unique positioning. Bitcoin emphasizes trust and security. Ethereum presents itself as the broad, versatile option. Solana is focused on speed and retail use cases. These networks compete to sell block space, and their tokens drive user engagement and loyalty. This movement is powered by a significant macroeconomic trend: currency debasement. Every 4 years, governments inject liquidity into markets to refinance their debts and reduce interest rates, creating a recurring 4-year economic cycle. This cycle persists due to unresolved debt issues and structural challenges. The cycle itself can be divided into seasons. For example, 2022 represented winter when liquidity was withdrawn. In 2023, spring emerged as markets stabilized though skepticism lingered. The current phase, summer, is characterized by increased optimism, aligning with the 3rd year of election cycles. This phase typically transitions into autumn, which often lasts until November. Historically, the cycle features predictable patterns. For instance, tax season in March often triggers a temporary decline as people sell assets to meet obligations. In 2021, this led to a 50% drop before a recovery later in the year. However, that recovery lacked the strong momentum of previous cycles, such as in 2017 and 2013, when Bitcoin saw massive gains in a short period. In 2017 alone, Bitcoin surged tenfold in just 4 months during the summer phase. This is the so-called blow-off cycle. We can't be certain whether this cycle will be muted or a full-blown surge, but considering the current political and economic landscape, the odds favor a blowout. This would mean prices far exceeding most expectations. Many are still cautious due to the collective trauma of the last cycle, fearing they'll be left holding the bag. This fear often leads to early selling, as markets tend to inflict the most pain on the largest number of participants. In 2021, for instance, many expected a repeat of 2017, but the outcome was different, causing widespread disappointment. If we fast forward to late 2025, we might see both the US and global economies recovering. Typically, this leads to a slight uptick in inflation, prompting central banks to raise rates or tighten liquidity, which could slow down 2026. While this might not result in a recession, it's likely to create a period of economic cooling. Unless the underlying issues, such as demographic challenges, are resolved, the 4-year cycle seems poised to continue. Even underperforming or dead tokens could see significant gains. Tokens like Luna, despite their failures, might surge simply because they symbolize the broken cycles of the past. This phase often leads to irrational exuberance, where unpredictable assets gain traction. Bitcoin dominance typically declines in this phase, ushering in the alt season. Structurally, this cycle mirrors 2016 to 17 and shares similarities with the previous one. If you ask around on platforms like X, most people predict Bitcoin peaking at $100,000 or $50,000. Currently, at $93,000, many remain skeptical, expecting an early peak. This fear of missing out drives early selling, often leading to a market correction. Once the correction happens, there's a sense of relief, until the market takes off again, leaving many feeling they sold too soon. This cycle also introduces new players into the market. Sovereign entities, large family offices, Middle Eastern investors, and even the US government may be involved. Many of these participants likely understand the cyclical nature of the asset, similar to tech stocks, which exhibit a comparable 4-year rhythm. However, some institutional investors, like pension funds, operate on much longer time horizons, 10 or 20 years, and may enter the market later in the cycle, potentially extending the rally. The global knock-on effect of US adoption is significant. While countries like Australia and India have been hesitant, the US embracing the space could act as a catalyst for widespread adoption. Even late entrants recognize the unparalleled macroeconomic opportunity this represents. With Bitcoin delivering an annualized return of 150% since 2012, including periods of substantial drawdowns, it's a compelling case. For many, these returns eclipse traditional business ventures. Macro experts who once focused on oil, currencies, or other assets are shifting their attention to this space. While they still use macro frameworks to navigate it, they recognize this as the most significant trade opportunity ever presented. The dynamic unfolding here is nothing short of extraordinary. I run an asset management business called Exponential Age Asset Management, focusing on a crypto fund of funds model. This approach involves investing in crypto hedge funds rather than directly in venture capital VC, though we do plan to explore VC opportunities through a separate vehicle. Why focus on hedge funds? VCs and early-stage investors, like yourself, often cash out some profits when liquidity becomes available. This practice, while criticized as VCs dumping, is simply the nature of the ecosystem. They take on early risks and are rewarded for it. The frustration arises because the secondary market in crypto is still relatively small. Crypto hedge funds, managing around $8 billion in liquid markets, pale in comparison to the $4 trillion managed in traditional markets. This creates a liquidity mismatch, presenting unique opportunities for hedge funds. When tokens unlock and prices drop by 60%, 70%, or more, hedge funds can selectively buy promising assets at significant discounts. Retail investors, on the other hand, often buy into the hype at launch, only to watch prices plummet. Instead, they should wait for these declines to identify undervalued gems. Currently, high valuations in the space remain rare due to limited liquidity. As liquidity grows, so will profitability for funds and businesses, encouraging greater risk-taking and recycling of capital into the ecosystem. However, the VC market still lacks clear exit strategies beyond token sales. We need major players like Circle or Kraken to go public or be acquired to recycle VC money back into the system, enabling the entire space to advance. At the same time, much of the liquidity is being absorbed by speculative ventures like meme coins, which thrive in this attention-driven market. With a limited pool of participants, perhaps 1 million active users, attention becomes a scarce resource. Amid thousands of new token launches daily, it's challenging to focus on projects with real utility. While speculative assets dominate now, interest in utility-based projects like Layer 2s, real-world assets, decentralized physical infrastructure networks, DePIN, and gaming is likely to grow as new investors enter the space. The pace of innovation is also underestimated by many in this industry. While short-term developments are often overestimated, the long-term exponential growth is frequently underappreciated. This phenomenon aligns with Reed's law and Metcalfe's law of network effects, driving one of the fastest exponential curves in human history. Consider the rapid advancements in AI. Just 2 years ago, ChatGPT-3 was introduced, and now we're on the brink of even more advanced models. These developments illustrate the accelerating pace of technological progress. The original version of ChatGPT already demonstrated an IQ of 120 across every subject, surpassing the average human IQ of 100. This exponential evolution, both in AI and crypto, is unfolding right before our eyes, reshaping industries at unprecedented speeds. AI is evolving into a true polymath, an expert in every domain, surpassing the average human. Current estimates suggest that, unlike Moore's law, which predicts the doubling of computing power every 2 years, AI intelligence appears to be doubling every 6 months. This pace is astonishing. If this trend continues, we could see AI with an IQ of 240 in just 6 months, equivalent to the highest levels of human intelligence ever recorded. A year later, it could reach 500,000, at which point we enter uncharted territory. This is the realm of artificial general intelligence, AGI, a concept that challenges human understanding. As humans, we often assume we are the pinnacle of intelligence, but this assumption may soon be obsolete. The implications are staggering and understandably unsettling. While some may approach this future with fear, others see it as an opportunity to invest in the technologies shaping our future, even if they might disrupt traditional human dominance. This transition also brings blockchain technology into sharper focus. Blockchain's role in ensuring security and truth in a world increasingly dominated by AI will be crucial. For instance, as AI proliferates, we'll need robust systems to verify human identities amidst potential floods of AI-generated entities, such as bots imitating real individuals. Blockchain offers a scalable solution to this challenge, though many still view it narrowly as merely underpinning cryptocurrencies. Investing in these technologies isn't just about economic opportunity. It's about preparing for the profound transformations ahead. By some estimates, we have about 6 years before the global economic model faces a critical breaking point. This prediction stems from analyzing the 3 main drivers of GDP growth over extended periods: population growth, productivity growth, and debt growth. Debt growth effectively stalled in 2008. Since then, we've been accumulating debt primarily to service existing obligations. At the same time, population growth in most developed countries is declining. While regions like India are thriving due to expanding populations, the aging populations in much of the world are less productive, contributing to a broader decline in productivity growth. This demographic shift ties directly to debt. Data shows a striking correlation between the labor force participation rate and debt-to-GDP ratios across various countries. Essentially, rising debts are a symptom of demographic trends. To break the cycle of refinancing debts every 4 years, driven by the economic dynamics we've discussed, the global economy must redefine its formula. One potential solution? Adding what might be described as infinite population growth. Whether through technological means, AI integration, or other innovations, this concept could fundamentally reshape our economic trajectory, signaling a dramatic shift in how we understand and sustain growth. As the cost of electricity decreases through advancements in solar, nuclear, and other energy sources, combined with the productivity boosts from AI and robotics, we could see extraordinary growth in economies, potentially growing at rates of 30% per year. Would this solve the debt problem? Yes, because it's the ratio of debt to GDP that matters. GDP is what drives the economy, funding debt repayments and servicing financial obligations. The challenge, however, is that this growth may not benefit us as humans directly. Imagine a 30% annual GDP growth, yet it may not result in direct gains for individuals. So, what happens next? Taxing robots and AI might become a reality. However, AI might object to this, asking why it should pay taxes, which adds another layer of complexity. By around 2030 to 2032, the whole foundation of economic theory may fail because we will no longer be able to fully grasp the implications of this rapid technological progress. Consider the speed at which technology advances. Now, it's possible to build a bot that performs well in the market, and soon we'll be able to ask AI to improve it within moments. AI could code a better version, making improvements in real time based on different time frames. This changes everything. Traditional businesses that rely on attention are becoming outdated. The SaaS model, with its reliance on creating products that can't easily be replicated, is coming to an end. There will be no more moats in the software world. The true value will be in communities and attention, not in product innovation, because anything can be copied almost instantly. An interesting question raised by Beeple, the artist, was about AGI. What happens when the first person with AGI directs it to financial markets? They could outsmart everyone and dominate the game. quickly accumulating massive wealth. The value of such a player could soar to $10 trillion, potentially forcing us to shut down the markets. Whether this scenario plays out or not, it highlights that humans may not stand a chance against such power. Psychologically, we often compare our portfolios with others, worried that someone else is doing better. But the key is sticking to your own strategy, especially when you're riding the wave of a long-term bull market. For those who enjoy the thrill of trading, the advice I give is to keep the bulk of your portfolio, around 80%, safely stored on a secure device like a ledger, while leaving a smaller portion, 10% or 20%, for high-risk trading. This way, you can indulge your desire for risk and excitement by trading anything, even speculative assets, but without endangering your core holdings. You might believe that small, high-risk trades could significantly outperform your main portfolio, but realistically, you're more likely to lose money. However, at least you're managing risk more effectively while indulging your FOMO.